Welcome back to another episode of the $100 to $10,000 series, where I invest $100 every month to the Vanguard S&P 500 ETF until it grows to $10,000, to show everyone that investing doesn't have to be difficult or complicated. This week, we're down 2.27%, and overall, we're up 19.2%. Last week, Jerome Powell spoke about the Fed's new monetary policy, so I'm going to go over that a little bit because as investors, I think it's important to understand what is going on in the economy at a macro scale as well. Since 1981, important economic figures like the Fed's chairman, Jay Powell, meet every year in Jackson Hole, Wyoming, to discuss policy matters regarding the economy. And every year the topic changes. For example, in 2007, when the housing market bubble caused the financial crisis, the topic was on housing finance, and monetary policy. This year, the topic of discussion was navigating the decade ahead, implications for monetary policy. As we all know and have experienced, the pandemic has caused our incomes to collapse, and the Fed and the government have been trying to fill those holes in the people's incomes and raise asset prices through monetary and fiscal policies, like giving out loans to airlines that would otherwise go bankrupt, or just sending a check to everyone, making under a certain amount. And in the process, a lot of money had to be printed out to support these programs, which raises concern of high inflation. Inflation is generally defined as the rise in prices of goods and services, but more specifically, the Fed uses the Personal Consumption Expenditures Price Index, also just called the PCE index. And the PCE index basically tracks the prices of the things that consumers like you and I buy every day. In a normal economy, the Fed tries to keep inflation rates at 2%, mainly by controlling interest rates. And the Fed typically will raise interest rates when inflation is too high, which usually means the economy is booming and growing, and so the higher interest rates suppress more borrowing. And during times when the economy is not growing or declining, the Fed will lower borrowing costs by lowering interest rates and try to boost inflation. During the symposium at Jackson Hole this year, the main takeaway I had from hearing Jay Powell's speech was that inflation rates will be maintained at the 2% level, but over a longer period of time. Meaning, if the inflation rate was 1% for the past decade, then if the inflation is 3% this year, the Fed won't raise interest rates right away to try to keep the inflation rate down. And the main goal that the Fed is going to target is to try to keep unemployment rates as low as possible. This strategy is the complete opposite of what the Fed did in the 1970s, when the end of the gold standard caused rapid increasing of inflation, but also with a high unemployment rate. And when this happens, it's called stagflation. At first glance, this concept seems impossible, and economists thought so too for a long time, because if you have rising prices of goods, it typically means that the economy is strong and the unemployment rate is low. But in the 1970s, when President Nixon ended the gold standard, which tied the value of gold to the dollar at $35 per ounce, inflation started rising out of control. But the unemployment rate didn't rise with inflation in this case. And so, there was a big decision for America to make here. Either cut interest rates to promote economic growth and let inflation go wild, or let unemployment rates rise and raise interest rates to try to control the inflation. And the Fed chair at the time, Paul Volcker, decided to raise interest rates instead of trying to lower unemployment rates, which is the complete opposite of what today's Fed chairman, Jerome Powell, is planning to do. And as a result of this policy of raising interest rates, despite the rising unemployment rates, the interest rates hit 20% at the time, and unemployment rate went up to 10%. But the period after the raising of interest rates to record levels was a fairly good period for the American economy, with low inflation and steady growth. So the big question we have to keep an eye on is whether the Fed's new strategy of prioritizing unemployment rates over inflation rates will have the opposite effect of what we've seen in the 1970s. That's going to do it for this video. If you guys enjoyed, don't forget to like and subscribe with the notification bell icon turned on, and I'll see you guys in the next one.